Recent developments indicated a temporary easing in the U.S.-China tariff conflict with a trade negotiation agreement reached in Geneva, Switzerland. However, the underlying tensions remain unresolved. Recent statements from President Donald Trump and Treasury Secretary Scott Bessent underscore the continuing risks. On May 16, President Trump spoke on Fox News' special report addressing U.S. investment, trade negotiations, and his trip to the Middle East. Discussing the tariff reduction deal, he asserted that China is facing greater economic harm than the U.S., and that had he not done the deal with China, they would have broken apart.
If I didn't do that deal with China, I think China would have broken apart.
Host Brett Baer pressed asking, "Not us, them?" Trump replied firmly, "We're not going to break. They would have broken apart." This stance reflects Trump's consistent hardline approach to China. It also shows he views diplomatic achievements as key milestones of his administration. This is not the first time Trump has said the trade war will collapse China's economy. Before the Geneva negotiations, he told NBC that he might reduce tariffs on China at some point. Otherwise, with tariffs so high, trade between the two countries could never resume. Trump said, quote, "They want to do business very much. Look, their economy is really doing badly. Their economy is collapsing." Trump's statement reflects concerns about the real state of China's economy. Our channel has reported extensively on China's economic situation. There is speculation whether the Trump team has reviewed these reports. Before the tariff pause, many analysts lowered their growth forecast for China in 2025. Investment bank Nomura warned the trade war could cost China as many as 16 million jobs. Reuters reported one major reason China sent He Lifeng to Geneva was domestic economic pressure. Three sources familiar with the government's thinking said internal signals show Chinese companies are struggling to avoid bankruptcy. Tariff-affected firms have difficulty finding alternatives to the U.S. market. As other countries negotiate with the U.S., officials privately worry about tariffs' economic impact and the risk of isolation. The May 11th negotiation agreement was at best a tactical pause. Commentators widely expect a new and possibly fiercer round of conflict. An industry insider said, "This handshake feels more like both sides repositioning themselves, preparing for the next round of competition." The facts show U.S.-China trade friction has evolved beyond economic issues. It now involves supply chains, technology, security, and rule setting. Future relations will shift from full cooperation to limited cooperation combined with deep competition. While tariff tensions persist, China released new economic data. The National Bureau of Statistics reported on May 19 that April industrial production rose 6.1%, down from 7.7% in March. April retail sales grew 5.1% year-on-year, below March's 5.9% and economists' predictions. Urban unemployment stood at 5.1% in April, slightly improved from 5.2% in March. Bloomberg noted that the latest data provides the most complete view so far of China's response to escalating trade tensions. Weak retail sales in April show government subsidies for consumer goods are losing momentum. Years of sluggish real estate market and fears of layoffs in manufacturing and exports due to the trade war have kept consumer confidence fragile. Citigroup economists pointed out that the portion of term deposits among all household accounts hit a historic high in April, indicating people may be maintaining a deleveraging approach. Zhang Dawei, chief analyst at Central China Real Estate, said April's slowdown reflects weaker policy stimulus, ongoing trade tensions, and seasonal demand decline after March's usual peak. He added, "Policy interventions have not fundamentally changed buyers' long-term market outlook. Ongoing economic uncertainty and unstable incomes make potential buyers increasingly cautious." Signs of weakness also appeared in commodities. China's daily crude oil processing in April fell to 14.1 million barrels, down 4.9% from March's 14.9 million barrels, and down 1.4% year-on-year. Crude steel output dropped 7% compared to March. The Wall Street Journal analysts say these data show that as overseas trade worsens, China's domestic economy is losing momentum, highlighting its sensitivity to trade disruptions. China's National Bureau of Statistics also reported unemployment dropping from 5.2% in March to 5.1% in April. But independent evidence shows some factories heavily reliant on U.S. market have laid off workers. According to data released by China Central Bank on May 14, new Chinese yuan loans by financial institutions in April fell 61% year-on-year to 285 billion yuan, hitting a 10-month low. This indicates weak loan demand in the economy. Loans to small and micro enterprises dropped from 35.3 trillion yuan at the end of March to 34.3 trillion yuan at the end of April. Financial blogger Lao Man analyzed that in just 1 month, small and micro enterprises' loan balances shrank by 1 trillion yuan, which is unprecedented. This means these businesses took no new loans and were aggressively repaying debt. Lao Man says this extreme situation could not be voluntary. The only explanation is that amid the U.S.-China tariff conflict, commercial banks have stopped lending to export-oriented private companies and are demanding immediate loan repayment. Strengthening loans to private and small enterprises is official policy and a key central bank priority, yet this policy was abandoned just as the tariff battle began. Lao Man emphasized that private enterprises hold real economic vitality, efficient investment capacity, job creation, foreign exchange earnings, and consumer spending. On the front line, fighting the U.S. tariff battle are not the visible government officials, but millions of China's export-oriented private firms. This tariff battle differs from a hot war. It uses not state armies, but millions of private businesses. Yet, ironically, just as the battle begins, the financial system abandons private firms by cutting off their credit and forcing repayment. This amounts to collective betrayal by China's banking system. It's basically taking weapons from soldiers on the front lines. The severity of this ruthless action is never seen before. Beyond Monday's economic indicators, other data released earlier in May also show China's economy remains weak and trapped in a deflation spiral. China's official Manufacturing Purchasing Managers Index fell to 49 in April, indicating a contraction. A PMI above 50 signals expansion, while a reading below 50 indicates contraction. CNBC reported April factory activity hit a 16-month low. New export orders fell to their lowest since December 2022, showing business sentiment is dampening by tariffs. Industrial output measures the value of production in manufacturing, mining, and utilities. PMI measures business sentiment. China's Industrial Producer Price Index also dropped 2.7% year-on-year in April, the largest decline in 6 months. Consumer Price Index also declined year-on-year for the third consecutive month, signaling ongoing deflationary pressure. Morgan Stanley said in a May 19th report that, given high tariffs and policy responses, deflation may persist. Economists note that in the short term, China may benefit from increased trade as U.S. importers rush to bring in goods before the 90-day tariff deadline expires. Container tracking firm Vision reported a 277% spike in 7-day average bookings through May 14th, reaching 21,530 20-foot equivalent units. However, the Wall Street Journal says high tariff levels mean trade volume between the two superpowers is likely to drop. Macquarie Group chief China economist Hu Wei-jun expects China's exports to the U.S. to fall by 1/3 over the next 12 months if tariffs stay at current levels. U.S. Treasury Secretary Scott Bessent also issued a warning. On May 18th, Bessent spoke on NBC's Sunday program Meet the Press about ongoing trade talks. He warned countries that lack in sincerity would receive formal tariff rate letters, adding he expects countries to negotiate sincerely. On tariffs for countries lacking sincerity or action, Bessent said, they will face the rate announced on April 2nd. Some countries will see 10%, others higher. At a press conference on May 19th, China's State Council Information Office addressed questions about the U.S.-China tariffs talk and their impact on China's economy. Fu Linghui, spokesperson for China's National Bureau of Statistics, described the international environment as still complex and severe, with many unstable, uncertain, and unpredictable factors. All countries' reciprocal tariffs are currently suspended for 90 days, maintaining only a 10% basic tariff. Several countries are negotiating with the U.S. to remove or reduce these tariffs. So far, only the UK has reached an agreement with the US. On May 11th in Geneva, U.S. Treasury Secretary Scott Bessent and Trade Representative Jamieson Greer met with China's Vice Premier He Lifeng, reaching a tariff agreement. Both sides agreed to reduce tariffs for 90 days. President Trump emphasized that if a trade deal is not reached within 90 days, tariffs on China will return, but not to the pre-Geneva level of 145%. He also said China has agreed to open its markets. China agreed to lift non-tariff retaliatory measures against the U.S. imposed since early last month. Reuters reported specific actions include 1. Easing rare earth export controls. China had placed rare earths under export restrictions in April, limiting critical raw materials in global supply chains. The new deal requires China to lift these controls. 2. Suspending anti-dumping investigations. China halted anti-dumping probes against U.S. chemical company DuPont and other U.S. firms. 3. Adjusting the blacklist. China removed certain U.S. defense and technology companies from its trade and investment blacklist. However, this applies only to measures imposed after April 2nd. Companies blacklisted in March and the anti-dumping probe on Google from February remain on the list. Despite tariffs on China dropping to 10%, the 20% U.S. tariff related to fentanyl imports remain. China still faces a 30% effective rate, with small packages not exempted. Existing tariffs on steel, aluminum, and other Chinese goods imposed before April will remain. China's actual tariff concessions are therefore greater than headline rates suggest. So did the U.S. make concessions? The answer is yes, but only after China made larger, more significant moves. Analyst Yuan Bin said raising tariffs was not Trump's goal, but a tool to force China to open markets and reduce its trade surplus. Now that this tool has worked, tariffs can be lowered. China's government will not disclose these details domestically. It promotes the narrative that Trump's tariff war is failing and the U.S. has sharply lowered tariffs. Supporters isolated in controlled information environments cheer this as a Chinese victory. Christopher Balding, senior fellow at the UK Henry Jackson Society, wrote that beyond the tariff deal, the U.S. appears focused on actual decoupling from China. Recent reports claim Chinese-made power components, including solar panels, contain backdoor software capable of actions like disrupting the U.S. power grid. With China actively decoupling from the U.S. and other countries, expecting changes in China's economic and security policies may be optimistic. Preparations should be made for no change. This agreement should be seen as an early step, not a conclusion. The Trump administration's next moves and the nature of any further agreements with China remain uncertain. However, these actions show the administration's deep concern over China and a clear desire to decouple as much as possible. U.S. Trade Representative Jamieson Greer said in a May 16th MSNBC interview that the U.S.-China trade relationship is deeply unbalanced. Greer highlighted structural issues in the relationship the Trump administration is working to correct. These include China's overcapacity, massive government subsidies to Chinese firms, intellectual property theft, and labor practices. Recently, U.S.-China container shipments have risen, but only during the current 90-day pause. The future remains uncertain. President Trump has stressed that without the deal, China's economy might have collapsed, signaling China must comply with the U.S. demands or face severe consequences. Japanese media veteran and Indo-Pacific strategy think tank head Akio Yaita stated that if China wants to do serious business, it must implement reforms. These include addressing covert subsidies to domestic exporters, environmental damage, and disrespect for intellectual property. Otherwise, another tariff battle is likely happening soon.